Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
So today was a pretty darn good day for rates. What's weird is we don't really know why. But that's what we're going to get to the bottom of here on the Thursday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Crawley, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories that are moving rates in 15 minutes or less. And that's what makes today kind of interesting because we actually don't really know why. I can tell you rates fell. I just don't know why they did that. I mean, we got data, we got reports, but nothing that would cause a movement that we are seeing. So put your detective hat on. I also want to warn you, I'm a little parched today. So if I have to grab some water, that's just the reality of the situation. So here's what I'm talking about. So the 10-year is down about 8 basis points. At one point, I think it was below 4.1%, but it's like right around there, 4.1%. According, like I said, that's the 10-year. And then the 30-year fixed, according to Mortgage News Daily's 30-year fixed index, they had it down 4 basis points to 6.1%. So the 30-year is at the lowest level since mid-January, so a couple weeks, and then almost a month. And then the 10-year is at the lowest level since the beginning of December, so over 2 months. And like I said, everyone's kind of like, why? why did rates fall? So to recap this week, Monday we had no movement. Tuesday we had some concerning retail data. Rates fell. On Wednesday we got a good jobs report. Blew everyone out of the water. And rates immediately jumped up and then kind of came down, and we didn't really see a huge move like we thought. And then today rates are down. And yeah, we're still trying to figure that out. So let's talk about Wednesday. So Wednesday we got the non-farm payroll, big jobs report. I think the number was around 40,000, somewhere around there. There was a whisper number of around 60,000. This report, 130,000. Blew everyone out of the water. 130,000 jobs created in January. That was the best report since December 2024. So this was the best report. No month in 2025 beat it. It was that good. And so you can understand why rates jumped up. And then, like I said, they did kind of fall back down, and we didn't see a huge move there. The unemployment rate fell to 4.3%, second month that it fell. And it's the lowest level since August. So pretty decent data from the labor market, kind of countering what we saw on Jobs Week when we saw job openings fall, jobless claims rise, and ADP's private payroll was not good. So this report was pretty much the opposite of all of those reports. Now, the one troubling thing, if you're looking for one, you're trying to find, why is this report maybe not that good? It's pretty much like two industries, healthcare, social assistance. Healthcare created 82,000 jobs in January, social assistance, 42,000. Now, construction did add 33,000, but most months it's been healthcare and social assistance. Government shed 34,000 jobs, and financial activities was down 22,000. Slight adjustments to November's report, down 15,000. So there's only 41,000 jobs in November. And then December was a little bit of a drop to 2,000, or dropped by 2,000. So a great headline number. Maybe you could say there's some troubling things because it does seem like it's really just two industries kind of propping things up. But like I said, a really good jobs report. And so it was understandable why we saw a slight increase in rates. But then as the day went on, so I think like when the report first came out, rates jumped by like 7 basis points. And then they just kind of slowly made their way back. And just to double check my numbers, at the end of the day, only up about 3 basis points, which, considering how good that report is, was kind of good news. And then today, we saw a downward movement in rates. Now, we did get some data. Let's stick with the labor market theme here. We got jobless claims. Now, maybe you could look at this and say, oh, this wasn't that good, but nothing jumps out at me. So initial jobless claims did fall by 5,000 to 227,000. And economists were expecting a larger drop. So, instead of being 222,000, it was 5,000 more than they were expecting. So, okay. Not exactly the end of the world. Continuing claims, of course, which tracks workers already receiving unemployment benefits, climbed to 1.86 million. That's the third straight weekly increase, but it hit a 2-year low 3 weeks ago. So it's like, okay, continuing claims climbing a little bit. Jobless claims didn't fall as much as they thought. Okay. You're not getting an 8 basis point move because of that report. It's not. It was not that bad of a jobless claims report. So that's why I think a lot of people were confused. Now, we did get a pretty, I wouldn't say troubling, but not a very good, almost like a reversal of what's happening with the labor market, existing home sales. So existing home sales unexpectedly fell 8.4%. I think they were projecting like a 2% drop. And it actually fell 8.4%. And actually it fell to a 16-month low. I mean, that's 4 times worse than they were expecting. The breakdown was the West saw the biggest decline, 10.3%. South fell 9%. Midwest dropped 7.1%. Northeast fell by 5.9%. Despite the big slowdown. Now the South, even though it only fell 9%, was a oversized impact because the South still makes up 46% of all existing home sales in the South. So when we move 9%, it's going to move that overall number. No doubt about it. What's crazy, though, is in December, we hit a 10-month high. So, I mean, December, 10-month high, and nothing really happened. I mean, I get it. January is always a slow month. That's just the way real estate is. December, things slow down in November. Holidays come, Thanksgiving, Christmas. And then January is kind of slow. February, and then, of course, in this area, things start kind of picking up. Probably like late February is when you start to see people thinking about the spring market because it is the South and it does get warmer down here versus, say, the Northeast. But that's just a crazy swing to get a 10-month high in December unexpectedly and then to have a 16-month low the next month also unexpectedly. And so that potentially could be it. That's maybe why we saw rates do what they did. That there's still this concern about housing, which is going to have, and let's face it, the Trump administration is concerned about that. That's why the president has talked many times about getting a lower interest rate. He is clearly concerned about the, people can't buy homes affordability, all of that. We've seen some gimmicks that were put forward last year by Bill Pulte. I think that's his name. I haven't talked about him in a while, so I've forgotten his name. Like the 30-year or the 50-year mortgage and the portable mortgage and just some of the other things that really didn't make any sense. And so they're aware of it. And so maybe there's this thinking that, with this bad report coming out, that this is going to spur them to try and find more ways to help with housing affordability. Come out with a new program. I don't know. But that's it. That's all we got. We got a jobless claims and we got a existing home sales report. And neither of them really would cause a drop like that. And so I did see a theory, though. This is from, look how old school I am. I printed out a tweet. I printed it out. I didn't want to bring it up on the computer. I printed it out. This is from Colin Robertson. Pretty good guy to follow. His handle is Mortgage Truth. He's been reporting on the industry. I think in 2008 is when he really picked up and started reporting on like the mortgage companies that were going out of business and everything. And so he's been in the business for a while, knows what he's talking about. This was his, what's the word I'm looking for? This was his theory on why rates are falling. He said, I got to thinking that mortgage lenders have grown more comfortable with rates at current levels. So rates didn't jump higher after yesterday's hot jobs report as they might normally. They were essentially flat. We did see initial jump, but then, like I said, 3 bips increase on that report was a little surprising. He says today they fell further thanks to higher jobless claims, maybe due to weak existing home sales data as well. The more time rates spend at lower levels, basically under 6%, the more solid they become. You can kind of see this from charts. They've spent a decent chunk of time in the low sixes and can perhaps take the next step down. So it also opens the door to move even lower if the data supports it without the need for any economic distress. Simply put, it becomes easier for rates to fall and harder for them to revert back to higher levels. This is why I still see fives for a 30-year fixed in our near future. Not a bad theory. Jeff Tucker, who's the principal economist at Windermere Economics, also chimed in on his tweet saying, quote, I think that's also contributed to the decline in the spread versus the 10, or in the spread versus 10s. The secondary market is less skittish about the refi risk. And of course, it doesn't hurt that GSEs stepped in as marginal buyers. Or maybe that's saying the same thing. The spread has almost normalized. And that's one thing that I always tell people this, and even people like who are in finance sometimes might not know this. The spread between the 10-year and the 30-year historically is around 185. I think it's 175 basis points. And when rates skyrocketed after the pandemic, around 22, 23 because of inflation, the spread also, so we got double whammied. So not only were rates going up just because they had to, the economy was normalizing, rates not only went up, you then saw the spread between the 10 and 30-year jump, because what happened is that all these investors in mortgage-backed securities thought that these new higher rates were likely to prepay. They thought rates were going to fall maybe faster than they did. And so they said, well, I'm not going to do this, 6% mortgage because rates are probably going to get back into the fours. And so I'm going to need a little bit more because of that prepayment risk. And so that's how rates got to 7 and then almost 8. Because they said, all right, we're going to give you more interest to make it worth your while to buy this bond. And so, okay. But then rates kind of stayed where they were. We did not see a return to the normal of the 2000s, which was like 4% or the 10s, when rates were kind of around 4 to 5%. And now we've stayed higher, obviously. But now we're getting to a point where people are feeling, okay, high fives, the stickiness of rates at their current level, that, an investor getting a mortgage bond at 5.875%, those people are unlikely to see rates fall to a point, assuming something horrible doesn't happen, that there's no real risk of prepayment, that they're unlikely to refi. And I think that's sort of what both Colin is talking about and, what was his name? Jeff Tucker. They're saying, listen, we're kind of in a new place with rates. Like the rates staying where they are makes it harder for them to jump up and easier for them to then fall as that spread normalizes. Because I think right now the spread's like under 200. Still above 175, but in like the 180, low 90, 190 area. And so we're almost back to normal. So not bad, I will say. Now, tomorrow, this could all change because we are getting a CPI report. And, based on the jobs report that we got a bad retail report that kind of surprised everyone, a good jobs report that surprised everyone. So now I'm thinking we're going to get a surprise tomorrow with the CPI report. But that could have some major implications because there's a concern about the labor market, but they need to see that inflation's falling. If we get a better than expected inflation report, ooh, baby, that could be good for rates. So we will see. We'll talk about that on Monday's show. I don't know. Maybe I always say that. Maybe we'll do a show tomorrow. I'm not going to do a show tomorrow. We'll talk Monday. All right. We'll talk Monday. All right. You guys enjoy your weekend. We'll see you back here soon for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.